Hi, and welcome to Yankin's Code on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to have a look at how to use derivatives to enhance risk capacity, meaning that its derivatives support risk-taking and the value creation process in the firm. All right, so for more on risk capacity, please consult my book, Empowered Enterprise Risk Management, co-authored with Petter Kapstad. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. So risk capacity is related to the idea of risk capital, having some capital in place to support the risk-taking that is necessary as part of doing business. And that means essentially having some kind of a buffer against that risk. And we're talking here financial resources, essentially, that help you cope with adversity, these worse than expected scenarios, so that you can function and, survive and thrive, basically, in these scenarios as well. So we're talking optimal strategy execution across a large number of scenarios, not just the expected one. Because as is well understood, to execute your strategy, it takes financial resources, and those tend to get scarce in worse than expected scenarios. So that's where a buffer comes in handy. So risk capacity on an intuitive level is simply some form of a cash buffer that helps you invest optimally, even in a worse than expected scenario. And so it's not equity as is the case with economic capital, for example, which deals more with solvency, the solvency of financial institutions, how to stay solvent and survive in worst case scenarios. We are talking about a liquidity concept here. Risk capacity is about the liquidity you have available to support your risk taking. Somewhat more formally then, it's the conditional cash now that you need to maintain the firm's value creating cash commitments with a certain probability. And here we have conditional inserted in this definition. So it's not just the cash we have in the bank, cash at hand. It's also what we can muster or verify that it's going to be available to us in worse than expected scenarios. And we're dealing with value creating cash commitments here. That is what creates a liquidity need for us. We need liquidity to implement and execute the strategy. But we're also going to accept a certain probability that we may not be able to do so. This is the trade-off we're going to have more to say on later. All right, so what risk capacity does essentially is to absorb cash flow shortfalls. And a cash flow shortfall is when your cash commitments are larger than what you're able to generate internally in the form of operating cash flows. Otherwise, zero. It's this is an asymmetric concept here. We're talking about finding ways to fill the gap that arises whenever your cash commitments exceed your operating cash flows. So risk capacity in this framework has three elements. You have the cash at hand, the excess part of that, some you always need to run business operations, right? And it's sort of tied up in the business, but there could be some excess cash as well, and it's equivalent. Then you have spare debt capacity, which is your ability to go to the market and ask for a loan to sort of bridge your financing needs and continue to execute the strategy. Derivative cash flows can also be counted towards risk capacity then, if they're available in scenarios in which you otherwise would have cut back on cash commitments for lack of liquidity. So these two here are conditional sources of cash, and for them to count towards risk capacity, we have to be able to verify that they will in fact be available in worse than expected scenarios. So it's not a fair weather assessment. We have to think about what this would look like in worse than expected scenarios and ask, can we count on these resources to be there in those scenarios? So here's an illustration of risk capacity. You have your variability in performance here around some expected level of performance. Operating cash flows will, in some scenarios, fall below cash commitments, given by this line here. And then then the issue arises: what's going to happen? Do you have resources to absorb that? And that's risk capacity. So, according to the level of risk capacity available here, you are going to absorb and cover these shortfalls, but only to some point, right? Which is here when you've used up and exhausted all your risk capacity. From this point on, we're talking scaling back in cash commitments, which usually is taken to mean cutting back in capex or investment, right? So you can think of this point here as the point of underinvestment. So all the probability mass to the left here in the tail, that's the probability of underinvestment, and it will be a function of your risk capacity and the amount of variability in your performance and the extent to which you have cash commitments. All right, so where do derivatives fit into this picture? Well, the normal view of derivatives is that they, we use them to hedge risk, so that we can reduce or eliminate an underlying exposure to market risk. And the case for this is to keep firms out of financial troubles, to generate a payoff when it's most needed, like when you're approaching financial distress or something similar. Derivatives can enhance firm value by making sure that enough funds are available in any given scenario. And that is very aligned with what we're talking about in this video, right? Because we're saying that derivatives can be used to enhance risk capacity in a fairly efficient way under many circumstances. And this is kind of a different perspective compared to thinking about derivatives as something that stabilizes operating performance. I mean, some firms view it as an integrated part of the operating part of the business. You're hedging revenue, let's say, that's their view, and they will even show the derivative payoff as part of revenue. So it's just a different perspective. But here we're saying that derivatives are part of the financial side of things, the assets and liabilities and the balance sheets that help us support risk taking and provide some kind of a buffer against variability in performance. So it's just a shift in perspective. So we're saying that in this view, then derivatives support risk taking, understood in terms of corporate strategies and investment, things you would like to do as part of your strategy to create value. And derivatives effectively lower the probability of disruption to this process, so you can keep on executing the strategy optimally across a large number of scenarios. So what we want to do is to design these derivative strategies in such a way that they most effectively absorb cash flow shortfalls. That's when they're doing their job and there's no slack in this setup. They are sort of explicitly designed to capture or sort of absorb shortfalls. And as we just talked about, that's when operating cash flows fall below cash commitments. And what are these commitments then? Well, you have the ones related to debt and its equivalents, things like interest payments and installments on debt. Those are of a legal nature, and you can get in all sorts of trouble by not honoring these commitments. You also have the discretionary commitments related more to strategy execution. We're talking capex primarily here in the investment program. So these are things that you would like to do as part of strategy execution, and they take liquidity. You have to have the money available for that. All right, so we're going to model this. We're setting up here a simulation of the oil price. So there's an expectation and some uncertainty around that forecast. And the volumes here are such that you produce this amount of oil and barrels of oil, oil equivalents. We're going to consider hedging some of that exposure. There's a put option available here where we've set the strike price to 45. And for now, there's nothing hedged. So we are retaining the full exposure here. We have some risk capacity before considering derivatives. 3 million here going in. Some of that will be considered operational, tied up to the business, and we really need it at all times. Some liquidity to just function, cash inflows, and outflows need to be dealt with. So let's say we won't go below a critical threshold of 1 million here, leaving 2 as excess cash. This is ready or readily available to finance shortfalls. We can draw down that excess cash if need be. We also have negotiated a credit facility, and we have secured that or verified that it will be available even in adverse scenarios, so that the bank won't retract on that. So before derivatives, we do have some risk capacity in place then to the tune of 7 million here, helping us absorb any potential cash flow shortfalls. So we're setting up our model here, a forecast for the next year. This is the oil produced times the forecasted oil price. I've assumed some numbers here for the cost side. We now have in place some net interest expenses as well related to the debt in the balance sheet over here. We're also we have some investment that we would like to undertake. All of these financials are forecasted right for the next year. So this is pretty much the strategy we want to execute. It takes this funding to do that. So we now have cash flow shortfalls, potentially, because when we start simulating over here, that will generate some scenarios in which operating cash flows fall below interest expenses and the investments. I mean, these are our cash commitments, right? So right now, this is not showing any numbers because operating cash flows in the expected scenario is enough to cover cash commitments. But we are going to designate the cash flow shortfall calculation here as a risk output, meaning that the model will keep track of all the scenarios in which it takes on a positive value here, or actually negative with the convention in this model. So we're going to do that with the help of at-risk, which is an Excel add-on for simulating risk in spreadsheet models. And we're going to basically remember that we've set up, this is illustrated in other videos, we were generating many scenarios now for the oil price, which is linked up to the revenue forecast, which in turn is linked up to the financial statements. So there's conditional uncertainty in all the financial forecasts now because of this. So we're simulating here, and this simulated distribution for revenue implies that there will be variability then also in the line for cash flow shortfalls. So in the large majority of cases, it's zero. We're able to self-finance and the operating cash flows take care of the needs. But there are also scenarios here where there are pretty substantial cash flow shortfalls. So we're talking about risk here, and what kind of risk capacity do we have to absorb this tail here of shortfalls that could threaten the value creation process? Because if these get large enough, we may have to cut back in investment, right? They could also threaten interest payments and the default risk in some other settings. So we're going to set up, this is also illustrated in other videos. I refer you to those. Basically, we set up a risk event in the model using the if statement such that it takes on the value 1 if proceeds from new borrowing exceeds the credit facility. That's going to signal that we're in excess of our abilities here, our constraints. We're facing some real hard constraints at that point. And it should be noted that whatever excess cash we have has been already depleted at that point. So that is what happens first. The model will draw down on that until the point where the minimum critical threshold of cash is reached, at which point the model will start to add or assume more borrowing. But that can only go on to this limit. That's when all risk capacity is depleted. And we interpret that as underinvestment then, because logically something has to give, and that would typically be, the investment program. You start scaling back on that so as to stay within your constraints. in the balance sheet. So it could be thought of as the probability of underinvestment when you do that in a large number of scenarios. Let's say you find that happening in 2,000 out of 10,000 simulated scenarios. It flags a 1. That means the probability of underinvestment is 20% because you are exceeding your constraint. So the probability of underinvestment then will be inversely related to risk capacity. The more risk capacity you have, the lower this probability will be. So that is how this works effectively. And with the current set of assumptions, that turns out to be 5%. So let's ask now, what if we, consider derivatives? What if we find this to be too high a number and we want to do something and we had the put option available? Let's go back and think about that, whether or not that could be a value creating for us. So the first step here is to find out at exactly which point do we need them. So we're saying here that, they should absorb these shortfalls. Well, a shortfall occurs whenever cash commitments are larger than operating cash flow. So at the point at which they're equal, that's when you start seeing a need for additional risk capacity potentially, because if the cash flow keeps falling beyond that level, that's a cash flow shortfall, and that is 45. We can solve for that. We just go back to the model and look at what kind of oil price assumption does it take to produce this identity here. When are they equal? Okay, well, let's select that for our strike price, which is the 45 that we've already entered. So we're trying to be efficient here. We don't want surplus, cash flows from these derivatives in many other scenarios, because that's just adding to cash. But there's a real cost to using derivatives as well. We want to preserve upside, etc. So we want to tailor the derivative strategy so that it yields these payouts exactly when we need it, which is given by this. Which happens at that oil price. So we're now going to go for a full hedge, 100% hedge ratio, the complete coverage of the exposure with this strike price. So this is generating, we have to pay for this privilege, right? And we're running, we have in place a Black-Scholes model here. We're not going to do that because we've shown that in other videos. So you can always go back and refresh on that there, but basically it's just a simple Black-Scholes calculation that will indicate a premium to be paid for this strategy, right? So we have a certain number of contracts, and we apply that to the premium that we calculate on a per contract basis. So that gives you the total premium. So that means, recall the risk capacity setup here. We're actually going to have less excess cash now because we need to pay this premium. So some of the excess cash really just exits here. It's no longer on the balance sheet. So the undrawn credit is the same as before, but put together, they're less than they used to be. So that's, but on the other hand, we have the derivative in place so that we're getting some risk capacity from that. The question is, how does that work out? We're giving up some excess cash, but we're getting risk capacity through the derivative instead. So we run again so that the revenue is as before, but the shortfalls are now much lower because these derivatives, they will kick in whenever cash commitments end up larger than the operating cash flows. That's how we constructed the strategy, right? So look here. I mean, I don't know if you remember the numbers, but they were much larger in the tens of millions here. Now it's down to a few million, meaning that the derivatives are very effective in absorbing these cash flow shortfalls. So the tail risk here is much less, which is what we wanted. We're saying that these derivatives should add to risk capacity. We're seeing that they do now. And checking our risk measure again, the probability of underinvestment is 0 now. So all that risk is gone because the derivative strategy is effectively absorbing all the cash flow shortfalls, or almost, to the extent that, but combined with the other resources, we're now seeing, the credit facility is able to take care of the rest now, all those remaining shortfalls that were simulated. So think of it this way: instead of 1.2 million more in excess cash, which is available in all scenarios, you get a maximum cash flow injection, because we're talking about a 100% hedge ratio, when there otherwise would have been a shortfall. So this is quite a bit. You get full. We have the full sort of hedge ratio here, generating a payoff precisely when you need it. So this is beginning to look like a very efficient kind of source of risk capacity, right? And this is what it would look like if you draw it up in Excel, right? So you have gradually falling oil prices here. The strike price is fixed, starts to yield a payoff here, getting ever larger, right? The more the oil price falls, so that the cash flow from the hedge, assuming a 100% hedge ratio, is this 1 million, going all the way up to 10 million here, and this potentially falls even further, right? So this goes on, compared to the excess cash then as risk capacity, which is available here this is the premium that we paid. So that is the extra sort of that we gave up to get this. Indeed, it does absorb cash flows here, or also cash flow shortfalls here. It does that, but it's quickly depleted. When the shortfalls get ever larger over here, we've already exhausted what was available to us excess cash. So we're talking about a fixed size buffer, as far as excess cash is concerned. It pretty quickly gets depleted in tail risk scenarios, whereas derivative cash flows dynamically absorb ever larger shortfalls, and that's a big difference. You have this leverage from the derivative that ensures the payoffs get larger. The worse the commercial situation. We're losing on the commercial side, right, from lower oil prices, but for every additional fall in the oil price, the payoff from the hedge gets larger. So it's dynamic in that sense. So it's a state-dependent payoff, and it's more efficient as a source of risk capacity when there's tail risk involved here. And we may, in fact, not need even the full coverage here. What if, it is a goal of ours to give away as the least possible upside. If you were using a collar to finance this put option strategy rather than cash, you're giving up upside to get the protection against downside risk, and we're saying that that's not desirable. We want to keep the upside potential to the extent possible, right? So the goal becomes to hedge the least possible while still taking care of the downside risk. And we're saying, well, let's explore then if we can achieve an acceptable risk reduction with a lower hedge ratio. So when we do that, I'm not going to show it here, but for example, when running with 50% hedge ratio, pretty much all the underinvestment risk is gone. So it turns out we don't have to go for the 100% hedge ratio. We can preserve some cash / upside potential, because that's what you save on, if you're using the collar strategy. So this is in line with our goal of preserving upside potential. We're not here to eliminate or get the lowest possible risk. We want to balance risk and return. And in some of these cases, derivatives are very powerful tools for that. So to sum up this video, derivatives can boost risk capacity then by making cash flows available when there otherwise would have been a cash flow shortfall. So it can be very efficient in the sense of you direct extra liquidity towards the scenarios in which that liquidity is most needed, and has a high marginal value. Excess cash is a fixed size buffer, quickly depleted in downside risk scenarios, whereas derivatives deal better with tail risk because it's dynamically absorbing these shortfalls. It gets larger the larger the shortfall. So due to this feature, derivatives are sometimes, a very efficient vehicle for dealing with tail risk, and in that sense, the most efficient source of risk capacity. All right, that was it for this video. Please read more in my books. Respecting.se. Please like and subscribe. Have a good day.